Hi, James Blacklaw's JB Commercial Finance here. I want to do a very quick video today talking about business borrowing and return on investment. Now, when you borrow money for your business, whether you're struggling or whether you're growing, buying a property or buying an asset, you do have to pay interest, I'm afraid. That's the way it works. And you also generally have to pay some fees associated with that, be it an arrangement fee, a redemption fee, valuation fees, legal fees, broker fees, etc. So it's important to look at how much finance will cost you in its entirety, whether you take it the full term for 10-15 year loan, whether you're looking to settle it early, whatever it may be. And you compare that costing to what you're looking to do in the business and how much money that's going to make your business, and then in terms of that filtering down to you and your lifestyle. And it's amazing how many times I come across a client, and you may go through the loan process, the application process, and when it comes to the final costings, they deem it too high to be worthwhile. So you'll sit in front of a client, and this generally applies more to the unsecured market, so the smaller loans for a shorter period of time. And they'll look for a loan for, let's say, £20,000, and by the time you've factored in your fees, your costs, your interest, it's going to cost them, let's just say, £25,000 over a certain period of time. And they'll look and they'll query this and say, well, that's going to cost me an awful lot. But you've been through a conversation with a client about what they're looking to do with the finance. So how are you going to spend this money? How is it going to benefit your business and then yourself down the line? And they say, well, I'm going to do this. And how much extra revenue is that going to generate for your business? £50,000. Well, if you're having to spend £5,000 to generate £50,000, that's a return on investment which is pretty strong, I would suggest. And yet a lot of clients don't see it that way. And there's only a couple of things I can put that down to. One, the misunderstanding of return on investment, or leverage, as we call it in the industry, i.e. using the asset, the money, to leverage more additional revenue for your business. Or secondly, the confidence in what they're actually looking to do with that money simply isn't there. Maybe they don't believe it's going to happen. Maybe the whole thing's based on a bit of a lie, a bit of a finger in the sky type affair with regard to the investment. And it never fails to amaze me how people will look at the cost of something, and that's not just in finance, that's in any industry, without actually understanding the potential benefit and value it will give to their business. And finance should always be measured, like anything in life, whether it's spending money on marketing, networking, premises, whatever it may be, should always be looked at from a return on investment point of view. If you're spending £10,000 worth of interest, but it's going to generate £50,000 worth of income, you are buying tenors for a fiver, and you should do it. Anything less than that, either you've got no confidence, or actually the whole thing is pretty much built on a bit of a lie. So hopefully that's helped, and helped understand how borrowing money can really leverage your business to help it work. For any more questions, queries, please get in touch. Contact details will be in whatever social media format this is put out on, and I look forward to hearing some feedback. Many thanks.